Access to capital is vital for the sustainable development of every business. But in spite of this, we see millions of businesses struggle to access capital. Business Growth Summit 101 in 2023 has been built out to address this challenge. On this platform, we will talk about how to access debt, equity, credit, creative financing, and hard money lending. We will also work with our clients to ensure that you understand not only how to access, but how to leverage and how to mitigate these financial portfolios that will really give you, the entrepreneur, a tremendous financial competitive advantage. So we encourage you to join us on these platforms on a daily basis that will truly enable you to transform the landscape of doing business. Welcome to another broadcast of the Business Growth Summit 101. Yesterday was the launch of this program, the start of this program, and we had a pretty exciting moment. I want to thank Allure Thompson. I want to thank Dr. Kelly. I want to thank Dr. Shakira and Jay Thompson for participating in yesterday's platform. Yesterday, we looked at how to start a US-based business. A lot of ground was covered. Today, we want to look at access to capital. But just before we get into today's program, I'm going to quickly recap some of the notes that was discussed yesterday. Yesterday on the how to start a US-based business, we talk about the importance of the Secretary of State. We talk about the importance of having your EIN and ITIN. We talk about your business address. We talk about the 411 number, your website, business checking account, business savings account. We talk about the importance of having your SIC code and your NAICS code. The SIC code means Standard Industry Classification Code. If you don't know that and you're in business in the US, you have some challenge ahead of you. What we do at Pitch Deck 101 is provide you with the support that you need to understand all that you need to know so you can set up your business properly and you're better prepared to grow and scale your business. You're better prepared to access capital. Today, we will be talking about access to capital. And we'll get the ball rolling with Jay Thompson. He will be talking a bit about credit card fundamentals. And we choose to talk about the credit card fundamentals for the simple reason that access to credit is the lowest hanging fruit when it comes to access to funding. But there's a lot of statistics that one needs to take away even before you start thinking about getting into any form of debt financing, credit financing. So Jed would give us a brief insight into credit card fundamental, and I trust that you have your pens and your paper and you're prepared to take notes on what he's talking about, because I want to show you the information that he will present is absolutely necessary. If you don't know this, it will get you into a lot of trouble as you start to access and leverage credit. Hi, Jay Thompson. How are you today?
I'm doing pretty good. How are you?
I'm at the top of the world, and I must say it's a pleasure to have you here today. All right, what I'll do, I'll pass control over to you. Now, Jet is currently studying investment banking. He has a rich history in branding and marketing, and he's also the branding and marketing representative for Pitch Deck 101 LLC out of New York and 10X B&M LLC out of New York. So, Jed, I will ask you now to take control. I'm excited to hear all that you have to share in terms of the credit card and fundamental. All to you, Jed.
All right, no problem. Hello, everyone. My name is Jay Thompson, and I am the branding and marketing specialist for Pitch Deck 101 and 10X B&M LLC out of New York. Today, I want to talk about the credit card fundamentals. And I believe that this is a very important subject matter because what we're seeing is that with the population of 332 million people, 70% of people carries a credit card, and 37 or 34 carries up to 3 to 4 credit cards. And guess what? 50% of the 7% of people that carries a credit card needs help with debt reduction support. And this is why I believe that every private or personal individual should take the time to understand the fundamentals of credit cards. So without further ado, let's get into today's program. So the credit card fundamentals stands under 7 important pillars. One, you need to understand your statements. You need to understand your balance. You need to understand your billing cycle. You need to understand your open and close dates. You need to understand your due dates, and you need to understand your minimum due. So let's talk about your statements. Your statement is very important because this is the first thing that you get when you apply for a credit card. And there are 3 things that you need to take away from your statement. One, you need to understand your credit line, you need to understand your credit utilization, and your credit remaining balance. What exactly is your credit line? Your credit line is the amount of money you have available to spend on your credit card. Next is your credit utilization. And this is how you're utilizing your credit card. And it is very important for you to know that your utilization must be below a specific percent. But in the next program, I will be going into this even deeper. Next, I want to talk about your credit remaining balance. And this is the amount of money you have remaining to spend. Next, I want to talk about your balance. And your balance is very important, but it can be confusing sometimes because there are 2 types of balance. There's the outstanding balance and the remaining balance. But let's talk about the outstanding balance. This is the amount of money that you have owed on your credit card. And next, there is the remaining balance, and this is the amount of money you have remaining to spend on your credit card. And this is very important. Next, I want to talk about your billing cycle. And billing cycle is very important because this is a monthly cycle that is used to generate a report for your FICO score. And your FICO score is generated by the credit bureaus such as Equifax, Experian, and TransUnion. Next, I want to talk about the open dates. And the open date is also important because this tells you when to start spending or start using your credit card. Next is your close date. And your close date is also important because this tells you when to stop spending and stop using your credit card. Next is your due date. And your due date tells you when to bring down your balance to $0 to avoid interest and balance carried over. And last but not least, I want to talk about the minimum due. And the minimum due tells you the least amount of money you can spend to avoid derogatories from reporting on your credit score. And there you have it. These are the 7 key fundamentals of your credit card. And if you want to know more about debt, equity, credit, hard money lending, and creative financing, feel free to go to our website, which is pitchdeck101.org, to book your consultation. Thank you.
Wow, wow, wow. That was indeed a powerful share, Jen. Access to capital is vital for the sustainable development of every business. But in spite of this, we see millions of businesses struggle to access capital. Business Growth Summit 101 in 2023 has been built out to address this challenge. On this platform, we will talk about how to access debt, equity, credit, creative financing, and hard money lending. We will also work with our clients to ensure that you understand not only how to access, but how to leverage and how to mitigate these financial portfolios that will really give you, the entrepreneur, a tremendous financial competitive advantage. So we encourage you to join us on these platforms on a daily basis that will truly enable you to transform the landscape of doing business. And what I want to do, I just want to, take Jade concepts and I want to go a little deeper into it. Thanks a lot for that presentation, Jade, in discussing the credit card fundamentals. I do believe that based on the fact that you would have said 53% of the American population need help in terms of managing debt, it's a pretty alarming statement. What this is actually saying is that above 90 million Americans are taking debt and they are struggling to exit their debt portfolio. Now, I want to bring a graphical picture to the statement that Jed would have made. Jed talks about credit line and credit limit and credit utilization. What exactly does all of this mean? Now, let us suppose that you have a credit line of $200,000 and you use 50% of that, which is $100,000. It means immediately that you have gone above the credit utilization. Tomorrow's program, Jade will talk more about this. But what this also means is that you're utilizing above the amount that you should be using because you've gone to 50% and you still do not understand a whole lot about credit cards. Now, let us suppose also that the credit card, the annual APR for this credit card is 30%. It means that on $100,000, when you disregard things like the billing cycle, open and close date, you disregard things like due date and minimum balance due, you end up being subjected to pay the annual APR. So in this case, the annual APR is 30%. The balance outstanding is $100,000. So the APR that is going to be calculated on that, when you disregard the open and close date, when you disregard the due date, the interest calculated on this is going to be $30,000 divided by 12, which is going to give you a sum total of 2,500 US dollars on that debt that you have incurred. And $2,500 is a lot of money. Now, what I want to do, because what Jade would have said is important, because in the US today, what we're seeing, a lot of persons are starting their businesses, and what they're using, they're leveraging their FICO score to access funding for their business. And my recommendation is that that is something that you should never do, because there are major differences between having a FICO score and having a PAYDEX score. As Jay would have mentioned, when you're leveraging your FICO score to access capital, several things happen. I'll just touch base on two of them. The credit line that you're accessing is low, all right? On the PAYDEX score, the credit line that you will be given is much higher. So that's two. Secondly, your utilization on personal credit should not be above 30% if you do not know what you're doing. That's when you're using your FICO score. On the PAYDEX score level, it's different. There's really no limit on your balance utilization when you're leveraging your PAYDEX score. So there are major differences between your FICO and your PAYDEX score. Everything that Allure Thompson spoke about yesterday, how to set up your business properly, is all about helping you to get your business set up in such a way that you're able to generate a PAYDEX score, and in generating a PAYDEX score, you're now able to access the much needed capital that you need to grow and scale your business. Now, we started off today's program in looking at access to capital by looking at credit financing and business credit, because access to credit is the lowest hanging fruit. The pre-qualifications for this type of financing is much lower than traditional financing. We have Dr. Felicia, and she will give us a deep dive into some other aspects of financial models. There's two more notes that I want to make very briefly. If you're in business in the US or in the developed world, and you do not have your SIC, which is your standard industry classification code, as was discussed yesterday, you have troubles ahead of you. The big question I want to ask, what role does having or not having your FICO score plays on influencing the cost for capital? It does. Because whether you know it or not, when you go to a financial institution in the developed world and you're asking for capital, they may ask for your SIC. They may ask for your business detail. Now, if you don't give your SIC or NACE code to them, guess what's going to happen? They will assign one to you. And when they assign one to you, it's not going to put you in the low risk category. It's going to put you in the high risk category. And guess what happened then? It either prevents you from accessing capital, or when you access capital, you access capital at higher interest rates. So the financial world is so much that you need to take the time, pause, get the right information, or ensure that you have a professional group of persons to advise you on that. And that's exactly why we have started this platform, is to provide you with a content of information that you either have to pay a lot of money to get, or you may not even get. But we're giving you this information free. And we are here at Pitch Deck 101 LLC out of New York. We are here at 10X B&M LLC out of New York to provide you with the intervention. And we have a number of subject matters, experts that are here with years of experience in the financial world. You will be listening to Dr. Felicia shortly. She has a tremendous background in finance. She represents over 100 financial institutions in her field. So these are just some of the things that I want to whet your appetite with today on the Business Growth Summit M101. Over the next few days and weeks ahead, we will do a further deep dive into these concepts so as to ensure that you truly understand financial model. In business, I keep saying that there's no lack of capital. You can access debt, equity, credit, creative financing, or hard money lending. I love to talk about creative financing. At another day, we will go deep into that. Starting a US-based business can give you a tremendous competitive advantage. Why? You're able to access a very large market in excess of 333 million consumers. You're able to access technology, and also you're able to access a diversified financial portfolio, meaning debt, equity, credit, creative financing, and hard money lending. We at Pitch Deck 101 LLC out of New York, we have started this signature project titled the Business Growth Summit 101 that will give you a step-by-step guide in terms of how to start a US business, how to scale that US-based business, and how to cash flow from a position of strength. So we encourage you to join us on a daily basis as we take you through this journey of starting and scaling your business. But without further delay, I want to invite the lady of the moment, Dr. Felicia. It's great to have you back again, Dr. Felicia. I really enjoy your energy, your wisdom, your charisma, and the tremendous knowledge that you're going to be bringing in terms of hard money lending. Dr. Felicia, would you care to reintroduce yourself for those who might not have been with us yesterday? And the floor is yours after that.
Excellent. First of all, thank you so much, Gary, for allowing me to be a part of this great initiative. This is exciting, very exciting. The Business Growth Summit 101, in conjunction with Pitch, is being sponsored by Pitch Deck 101 LLC. I'm just excited to be here. This is, as we really delve into this and we really look at business credit and look at ways that we can assist people in making their dreams reality. That's what this is all about. And that's the exciting part, that we as individuals that are here, that are a part of this summit, the team that's come together, that's working together comprehensively and cohesively to execute this Business Growth Summit. So my name is Felicia Watson. I'm a licensed real estate agent, both in New York as well as in Florida. I am also a commercial loan broker, and it is from that angle that I will be speaking today. I also have my master's in business administration from one of the top MBA schools in Europe, from Barcelona, Spain. But none of that matters in a real genuine way, except the fact that I want to assist people in making their dreams a reality. I really want to help people get to the next level in their lives. As I too am progressing, I always say leap in the net will appear. And it is important for people to understand. And I'll tell you that my colleagues, they did an excellent job yesterday talking about getting your business structured and getting the structure in place in a really concrete, sequential way. Because without that, what I'm talking about won't amount to a hill of beans. Without that, you will not be able to garner the dollars necessary to catapult you to the place that you really need to be and the place that you want to be. So I'm sure that Gary and my other team members, Jade and Allure, are going to continue to help us to understand the importance of structure and ensuring that our businesses are structured properly. Jade did an excellent job this morning, just recently, actually, on talking about the 7 key fundamentals of credit card. So I don't really have to touch that. That was an area that I could have touched when we look at funding businesses, but I'm glad he did, and he did an exceptional job in that area. So as we talk about the various types of businesses, the various type of business loans to help grow our business. So again, I'm going to be speaking as a business loan broker, and let's break that down. So I specialize in connecting businesses with lenders and investors, businesses, so lenders and investors to secure loans or to secure dollars to make their businesses reality, to help their dreams to come into fruition, or to grow and scale, or for sustainability. So those are the basic areas. One, new businesses. We can provide dollars for new businesses, startups. We can provide dollars for businesses that want to scale or to grow. And then 3, businesses that want to sustain themselves. Those are the basic areas. As Gary said, I do have access to lenders, and over 100 lenders we have access to. Now, here's the reality. That sounds good. And one of the things that you're always going to find with me is I'm genuine and sincere. While we may have access to those individuals, everyone will not qualify for all of their product offerings. So what Gary and his team at Pitch Deck 101 do is they try to systematically, comprehensively, and cohesively find out exactly what the consumer or the individual that's seeking a loan wants to do. And then they try to ensure or drill down on the ability for that person to get funding. That's the bottom line. One person's food is another person's poison. For some things you may not qualify for. Some things you may have to undergird yourself and strategically position yourself when it comes to getting your business set up properly. So as a business loan broker, there's some basic things I want to go over though before we delve into hard money lending and asset-based lending or funding. There's 11 basic types of business. There's 11 types. Well, there's 11 ways that I can assist you in growing your business and sustaining dollars. However, I'm just going to go over a couple of them on this on today. For me, I'm in Eastern Standard Time, so if I say morning, it's because it is morning. Still for me. If it's afternoon or evening, wherever you are, that's great. This is an international platform, and in the services that I can offer can be offered internationally. I'm working on a deal with a couple in Zambia. I'm here in the United States, and there's a deal that I'm working on with a couple in Zambia. Of course, the investing has to be within the United States, but we can provide funding for individuals who are not in the United States. Okay, so let's just delve in real quickly. Term loan. Let's just look at some of this from a comprehensive perspective. What is a term loan? So a term loan is perhaps the most basic, common and flexible small business loan that there is. It's simply an account of cash. That's it. It's an account of cash issued in a lump sum that the borrower repays over a fixed amount of time, usually in monthly installments. Term loans can be used for virtually any aspect of your small business, including equipment, marketing, or everyday expenses. So I have access to lenders who are able to provide term loans. In all of these areas, we have access to lenders. A business line of credit. let's just say you need a business line of credit. What is it? It is essentially a business line of credit is essentially a business card. Remember, I said that Jay talked about that, but he did an excellent job. He talked about the 7 key fundamentals of a credit card. Well, this setup is essentially a business credit card minus the card. Okay. It usually is linked to a checking account. A business line of credit comes with the limit set by the issuing institution, the financial institution. A business can borrow money up to that limit. After the borrower repays the debt, they can again take out cash against that limit. That is essentially a business line of credit. So you may be in need of a business line of credit, or you may be in need of a term loan. Whatever your needs are, Pitch Deck 101 is able to align and to drill down on assisting you to find out exactly what you need, and then making sure that we provide that for you. An SBA or Small Business Administration loan. Many of you have heard about that. SBA loans are backed by the government. As a result, or subsequently, they're a little more stringent. It's a little more difficult. They're attractive to many business owners because of their relatively low costs and interest rates compared to other small business loans. However, SBA loans can be utilized. Let's look. They can be utilized for business purposes, including startup, capital equipment, inventory, real estate, and more. However, the downside to the SBA loan is that it's a drawn out long application. It's a stringent process. It can be extended for about 3 months before you even receive the funding. 3 months, that's 90 days. So if you're looking for a quick hit, fix and flip, and you're trying to do some real estate investing or something quickly, this is not the loan that you're going to want to try to secure. So it's not appropriate for emergency needs. But if you can wait for approval, the SBA loan could be something that is great for you from a cost effective perspective. Equipment financing. Now, when we look at equipment financing, we're looking at that many different avenues. Yesterday, I mentioned briefly that if you're a dentist, there may be equipment that you need. If you have a fleet of trucks and they're wearing out, you need to purchase new trucks. The equipment financing will work for there. If you're a chef and you need to buy equipment in order to cook, if you're in the culinary arts, there's equipment perhaps that you need. If you're a beautician and honey, you want the hair fierce and fabulous, and you need to purchase some things to help in that avenue, these loans can help you. If you own a dry cleaners and you need and some of your equipment is getting old or dilapidated, this type of loan can assist you. Equipment financing helps a business owner buy or replace equipment without having to pay for large items all at once up front. We know that that's an issue, honey, when you got to fork out big money up front. The owner can pay in monthly installments for major equipment, which is used as collateral. So again, this is collateral-based funding. It's based upon the equipment itself. Equipment financing is helpful because it keeps a business operational without a big cash dump burden. So you're not having to dump a boatload of cash up front in order to obtain the necessary equipment that you need in order to sustain your business. On the downside, there's always upsides and downsides. Make no mistake. Let no one tell you otherwise. Probably the preponderance of loans, there's upsides and downsides. That's why it's important for you to drill down, work with someone like Gary and his team at Pitch Deck to find out the absolute one that best fits your needs, that's optimal for you. The downside is that the lender can repossess the equipment in the case of default. That means take it back. But the owner's personal assets, and this is a good thing, the owner's personal assets are not adversely impacted. So that's a good thing. The next one is a merchant cash advance. These, again, are types of business loans to help grow your business. We're just going over a few. There's a boatload of them, and that we provide funding for. But these are just a few this go around on this Tuesday that we're going to be bringing to you. Merchant cash advance. In a merchant cash advance, the owner borrows money against the expected sales in the future, essentially offering credit card sales as collateral. Again, collateral, that word, I want you to make sure that you're taking notes on this and that you jot that word down. Collateral, it's key as I talk about creative financing and asset-based financing. The owner repays the debt through daily credit card transactions or via weekly transfers of cash from their bank account. This kind of finance comes with a very high risk, simply because future success is never 100% predictable. I think if we all had an 8 ball and we can predict exactly what was going to take place, it would be seamless. It wouldn't there, the high risk will not be there. But because we don't, and right now in 2023, we're dealing with different discussions of recession. Are we in a recession? We're not in a recession. The inflation piece, the economy, just all of that. And so things are kind of all over the place. And there's not 100% clear definition to exactly what's going on. Here's the reality is that we're alive and well. And as long as we're alive, we're going to keep pushing through to strategically position ourselves, build our businesses, make our dreams reality, and do what we have to do. And therefore, we're going to need funding. So when we look at it, the interest rate can be extremely high with these merchant cash advances. However, in some cases, the lender may agree to adjust the borrower's payments downward during times when business is low. We do see that happening. Another one is a startup business loan. So when we look at a startup business loan, this is a non-traditional loan. Non-traditional, we're going to break that down a little bit forward. When we look at traditional versus unconventional loans, is that a non-traditional loan is geared toward businesses that have been in operation for less than 2 years. This is typical. There's always a caveat to everything, but generally speaking, businesses that have been in existence less than 2 years, it can provide anywhere between $500 to $750,000 to start a business from the bottom up. These dollars can be used for everything from equipment and property to inventory and staffing. So when we look at startup business loans, this is a really viable way. A startup loan is an alternative to investor financing, meaning the owner keeps complete ownership of the business without having to answer to a stakeholder. However, these loans can be hard to qualify for, especially for owners with challenging credit histories. That's what Jade was talking about with the credit card and a little bit about credit scores. And I know that the Business Growth Summit is going to be delving into that more as we continue with these summit content. Plus, if the startup fails, the loan will still be due. So you don't get to say, well, it didn't do so good, so we're just gonna dip out. No. It will still be due. You're still going to have to pay it. And then finally, I want to look at microloans. Microloans are typically issued in amounts less than $50,000. These are small loans. They're good for owners who need a little cash for a one-time business expense or a startup that doesn't need much money. Some microloans are issued by the government, while others are offered by nonprofits or even hard money loan lenders. However, for them, they typically start out around 100,000, at least the ones that I deal with. But there are some that can lend as low as $50,000. Collateral, again, is usually required. We've heard that word over and over and over about collateral. So we're going to now look into creative financing in a concerted way as we look at creative financing. So we've laid the foundation with talking about a variety of different loans, different ways to grow your business, different ways that you can access capital. So now let's look at the term creative finance. And a lot of these terms are loosely used, and that's cool as people educate themselves, as they build their wings, as they really get a pulse of exactly what they need and how they're going to get it. Many times people are utilizing a variety of ways to fund their business. They're not using one way. They're getting a little bit here, another amount here, and another amount there. And so it's by any means necessary. They're getting the dollars in order to sustain themselves, to build their business. And the bottom line is that's a beautiful thing. Just make sure that you continue to educate yourself. We know that the Dodd-Frank Act of 2010 put in place a lot of stricter regulations when it comes to creative financing. That previous to that, there were a lot of things that could have taken place. But with the implementation of the Dodd-Frank Act of 2010, there are now stricter rules to creative financing. And that's not a bad thing for consumers, because things, it was like the wild, wild west to some extent, and things were out of control. And that's how we fell into with the recession of 2008, and with all those subprime loans, and folks were being bastardized because of lack of knowledge, and because they didn't have the knowledge to understand this. They were putting their confidence in the lender, and they were putting their confidence in individuals who they thought were working and on their behalf, and doing things that were for their benefit. But as we all know, that was not always the case. So when we look at creative financing, it's a process that doesn't involve conventional lending practices. And this type of financing, an individual or specialized tactics to obtain funding for real estate purchases. The financing technique doesn't rely on traditional lenders like banks or credit unions to fund their real estate activities. We touched on that just a bit during the Business Growth Summit, the kickoff on yesterday. So if you didn't get a chance to listen in, definitely listen to the replay, and you'll get somewhat of a leveling ground with some of that. So when we look at creative financing, when we look at real estate investing, when we look at the various types of creative financing, whether it's seller financing, whether it's lease option, lease purchase, rent to own, self-directed IRAs, or any other type of loans, the focus is always on an avenue to creatively garner the dollars in order to pay for whatever you're trying to do, whether it's investing in a home, the purchase of equipment, um, uh, rehabbing your hair salon, rehabbing your dry cleaners, whatever it is, rehabbing your car business, whatever it is. So one avenue of creative financing is hard money loans. That's just one avenue. Is hard money loans. So hard money loans are short term. Are we okay, Gary? Hard. Are we okay? I just want to make sure I see something pop up. All right. So let me just continue. Hard money loans are short term secured loans that use the property you're purchasing as collateral. You won't find one from your bank. Hard money loans are offered by alternative lenders, such as individual investors and private companies who typically overlook mediocre credit scores less than 680, and other financial factors, and instead base the decisions on the property to be collateralized. Remember, we talked extensively about collateral, the word collateral. I said, jot that down. So while you might jump through a fewer hoops to get a hard money loan, comes with risk, and it isn't the best option for everyone. There's no one size fits all for everyone. So you got to make sure that you go into this with your eyes wide open, and that you're securing the loan that best fits your needs, not just for today, not just you're excited and you can access the dollars, but you must also have an exit plan in place to know how you're going to pay that loan back. So that's going to be critical. Um, when we look at hard money loans, we look at the house flippers. House flippers buy fixer uppers to rehab them in hopes of selling them at a hefty price. So many times these individuals will look for hard money loans. Rental property investors in rental properties might rely on hard money loans as a quick source of cash to finance a deal. The beauty for collateral driven entities is the beauty is in the deal, not in the individual consumers' personal assets or any of that. It is based upon on the deal, the collateral, the asset itself. And then business owners might take out a hard money loan to purchase commercial real estate that they can qualify that they couldn't qualify for from a traditional bank or traditional financial institution. What are the benefits? And we talked about this a little bit yesterday. What are the benefits of a hard money loan? One, they often close faster than a traditional loan does. From start to finish, a hard money loan can take just a few days, 7 to 14 days, versus versus 30 to 45 days. Their underwriting process is less rigorous than a traditional loan. Why? Because hard money lenders tend to place more weight on the value of the property used as collateral than on a borrower's finances, a borrower's employment, a borrower's fiscal fitness. There's tends to be less down payments, and the loan tends to be funded at a higher rate. So 75 to 80% of the value of the marketable securities can be funded with a hard money loan. So these are just some areas. Another piece I want to throw out too is that there's less focus on debt to income ratio, the debt to income ratio. So those are just some basic benefits of hard money loans. What are some of the risks? Some of the risks. There's always risks. We said that there's upside and the downside with absolutely everything. The interest rates are typically higher. Hard money lenders typically charge a higher interest rate because they're assuming more risk than a traditional lender would. Another risk or another risk factor or a downside is that they may require a higher down payment than a traditional loan would. Again, that's because of the risk that a hard money lender is taking. And that's only in the mortgage places. In some places it's less and some places it's more. So for example, with if you received a conventional or even an FHA loan, it could be substantially less than you can put down less than you would with a hard money loan. You can be required around 20%. The term is typically much shorter than what's offered on traditional loans. Traditional loans tend to be 15 to 30 years. For hard money loans, they tend to be 1 to 3 years. And in some cases, 6 months to 1 year. So it depends on the loan. It depends on the lender and what the terms of the loan are. So as I said, the important thing is when you take out a hard money loan, you have to begin with the end in mind. You have to have in place your exit plan, which is how you're going to pay the loan back, because these loans are short-term loans. So you begin with the end in mind before the loan, you take out the loan. You need to know beforehand how within 6 months to a year you're going to pay it back, or 1 year to 3 years are you going to pay these dollars back. And that's a critical piece. So now we're going to move over to asset-based lending. Just as a quick recap, we talked about various ways of funding our business, and then we talked about creative financing. We talked about hard money loans, and now we're going to end a little bit with talking about asset-based lending. All right, so asset-based lending refers to a loan that is secured by an asset. Again, we talked about this yesterday. We're going to drill down on it just a little bit today and give you a little more knowledge than we did on yesterday, but not with all of these areas that I've touched. We can delve into each one and spend probably 24 hours talking about each one, 2 or 3 days talking about each one and teasing it out and drilling down on it. But because of time constraints, we're not afforded that opportunity. So we're going to do a little bit, and we're going to continue to build on your foundation of knowledge when it comes to funding your and growing your business. We're going to on a consistent basis give you gems, knowledge, and information that will help you so that you can go in to this and with your eyes wide open. So again, asset-based lending is secured by an asset. In other words, in asset-based lending, the loan is granted. The loan granted by the lender is collateralized with an asset or assets of the borrower. The benefits of an asset-based loan is that the asset-based loan refers to a loan. The asset-based loan is a loan that is secured by the asset. So it's the asset itself that secures the loan. Examples of assets that can be used to secure a loan includes accounts receivable. We talked about this yesterday. Inventory, marketable securities, which we said that many times they'll fund 75 to 80% of the marketable security, and property, plant, and equipment, which is the PP&E, which is inventory and equipment. All right. Lenders commonly use the loan to value ratio to determine the amount of money they are willing to lend. The loan to value. So the loan is the amount that the lender is willing to loan. What are they going to give you? And then the asset value is the value of the asset being used as collateral. And that's the ratio that they use to determine the amount of money that they will give to you. So, for example, right now I'm working with a church. There's an individual that's taking out a an asset-based loan for their church. It's a short-term loan. They only needed it for a short period, a loan for a short period of time. Of course, the interest rates are going to be higher, but it's making it easier for them to access these dollars versus going through a traditional bank or lending institution because it was extremely difficult for them. So then they opted to do an asset-based to take out an asset-based loan. They secured it, and we're in the throes of that even as I speak. So these are some of the benefits of an asset-based loan.
Our sales communication process stands on four important pillars. One, you get to understand the sales process, the communication process, the pull factors of sales communication, and the push factors of sales communication. The success of every business ultimately rests on the shoulder of your sales processes. Business Growth Summit 101 in 2023 will give you the blueprint on how to build and apply this sales communication process to truly optimize the growth and cash flow potential of your business. So, we encourage you to join us on a daily basis and learn how to apply these practical tools to growing and scaling your brands.
So there you have it. Today we had the Business Growth Summit. We talked a lot about a lot of things. We had Jay kick this thing off talking about the 7 fundamentals of credit cards. Exceptional job. He's breaking it down. And even in that topic alone, there are a boatload of things that he can delve into as we continue to the content topics of this Business Growth Summit through Pitch Deck 101 LLC. We're going to continue to break this thing down because one of the things we realize is repetition is the mother of learning. There is no way you hear this one time, even if you're a seasoned business owner, to hear this over and over, to learn about this with consistency is going to be pivotal for your knowledge, for your understanding, and for your ability to really grasp this comprehensively and cohesively. And then of course, Gary always does an excellent job. He's so learned. He knows so much. I'll tell you, as I listen to him and his wealth of knowledge, and his ability to just spew this information out, he always pulls this all together. And then of course I came through like a storm, honey. I talk fast, but I talk fast saying something. We talked about the various ways of growing your business. We talked about creative financing, and we talked about under creative financing, hard money loans, and then we talked about asset-based lending. So there you have it for the Growth Conference 101, day 2. We're super excited that you logged in with us. We hope that you've learned something, that you take notes, you listen to the replay, and stay tuned because there is absolutely unequivocally more to come. So as you scale up, remember that it is important for each and every one of us as to not just talk about it, but to be about it, to be on our hustle, grind, and to execute. And know that dreams, as we have dreams to expand our businesses, as we have dreams to go to the next level, that dreams are nothing but goals that help us to get to the next level. So thank you for tapping in. We look forward to hearing from our very own Dr. Shakira during our next show. And there you have it for our day 2 of our Business Growth Summit 101. Until next time, take care. Have a wonderful day. And remember to keep living your best life. It's Felicia Watson, and we're signing off for today.
Access to capital is vital for the sustainable development of every business. But in spite of this, we see millions of businesses struggle to access capital. Business Growth Summit 101 in 2023 has been built out to address this challenge. On this platform, we will talk about how to access debt, equity, credit, creative financing, and hard money lending. We will also work with our clients to ensure that you understand not only how to access, but how to leverage and how to mitigate these financial portfolios that will really give you, the entrepreneur, a tremendous financial competitive advantage. So we encourage you to join us on these platforms on a daily basis that will truly enable you to transform the landscape of doing business. Our sales communication process stands on four important pillars. One, you get to understand the sales process, the communication process, the pull factors of sales communication, and the push factors of sales communication. The success of every business ultimately rests on the shoulder of your sales processes. Business Growth Summit 101 in 2023 will give you the blueprint on how to build and apply this sales communication process to truly optimize the growth and cash flow potential of your business. So we encourage you to join us on a daily basis and learn how to apply these practical tools to growing and scaling your brands. Starting a US based business can give you a tremendous competitive advantage. Why? You're able to access a very large market in excess of 333 million consumers. You're able to access technology, and also you're able to access a diversified financial portfolio, meaning debt, equity, credit, creative financing, and hard money lending. We at Pitch Deck 101 LLC out of New York, we have started this signature project titled the Business Growth Summit 101 that will give you a step-by-step guide in terms of how to start a US business, how to scale that US based business, and how to cash flow from a position of strength. So we encourage you to join us on a daily basis as we take you through this journey of starting and scaling your business.